and welcome to ETNA's special coverage of the monetary policy. Today, the street awaits MPC's first bi-monetary policy of this new fiscal FY19. Now, here's what we're expecting. We're expecting the central bank to maintain a cautious stance and refrain from tinkering with rates despite the clamour for a rate cut in the wake of falling retail inflation. But the elephant in the room, I guess, is crude, considering crude prices have already had a touch-and-go moment with that $70 per barrel mark. So it's in a tricky spot. While the RBI may not really move on rates, a hawkish stance by the RBI and a tone to that effect cannot really be negated. Let's check in on what the equity markets are up to. They're really not waiting for cues from the monetary policy for sure. They've been taking their cues from Trump's tweet overnight and cheering that move across the global markets. So 10,300 here for the Nifty futures as we step into the monetary policy. Less than half an hour from now, you're seeing an excellent market breadth. 300 points, or rather 300 stocks standing to the advances right now, with just about 11 odd standing to the decliners. But Maithili, afternoon, welcome to the show. Like I was saying, that we're not expecting the RBI to move on rates, but can we expect a hawkish stance, considering the elephant in the room is inflation, and you can't deny that?
Well, yes, Aisha, it is not just one elephant. The problem really with before the MPC and the Reserve Bank of India is that at the moment there are many elephants in the room. So one doesn't know which one is going to create more havoc on the inflation front. So I, in fact, would strongly urge a hawkish stance, because in the past I've always felt that the RBI was excessively tight on monetary policy. But given the fact that monetary policy is always forward-looking, and it would seem to suggest that even though we have a lot of comfort on the inflation front at the moment, the coming months should see an increase in inflation, not just in India, but all across the world. And in a globalized world, imported inflation is almost as important as food inflation in India, which frankly monetary policy has very little of an impact on when you come think of food inflation. So I would think there is a strong case for a hawkish stance, but I must confess that the market doesn't quite agree with me. I think the general consensus is that status quo on rates and neutral stance. But at least at the very least, I would expect or hope that the tone should become a little bit more hawkish, so that people will know that the Reserve Bank has zero tolerance for inflation going out of kilter. And in that, I think they would have government support also, because as we go into an election year, the last thing that any democratically elected government, particularly in a country as poor as ours, would want is rising inflation. So definitely a case for a change in the tone to make it more hawkish, and ideally if perhaps a change in stance as well to be more hawkish. But let's see what we have in about half an hour from now, or less than that. So let's wait and see, Aisha, what happens.
Oh yeah, a herd of elephants, as Maithili rightly puts it, is what RBI will have to tackle. But Maithili, in February, we'd polled respondents as to what they're expecting from the RBI. And nearly 33%, I remember back then, believed that we may see rate hikes, but only in the second half. And now in the month of April, nearly 56% believe that we may see rate hikes from the second half onwards. What is your view from the rest of the FY19? Up until now, RBI has not moved. But when are they going to move on rates?
Oh, well, yes, but many things have changed since the February meeting. We saw the government slip on the fiscal deficit target. We saw it announce a more liberal MSP. We saw Trump launching his trade wars. We saw rate of interest hike by the Fed. So and we saw oil prices go up. So we've really had many reasons there. There's a huge sea change between what the MPC was looking at in February and what it is looking at right now. At the same time, we have much clearer signs of recovery on the growth front. So I think once again it's time for the inflation issue to come to the forefront, and maybe growth will kind of sustain on its own, given that demonetization and GST, the two big elephants that we had in the past, have been largely sorted out. And the perhaps the first projections of the monsoon also suggest that the monsoon will be normal. So maybe the RBI could take a more relaxed stance on growth and focus once again on inflation. Of course, in the past, it's always been focusing only on inflation. So maybe it could just play true to, its that normal character and focus once again on inflation, and with some justification.
Rightly so, because the headline CPI has eased because of the lower food prices. But now, Maithili, with crude prices spiraling upwards, core CPI does remain sticky. What is your own assessment of whether or not RBI is going to change the inflationary expectations, and if so, by how much?
Well, that's a very tough call. really, Aisha. But the fact is, RBI's inflation projections have always been higher than what the market, what you finally got. So the RBI has always tended to be estimate inflation with a higher trajectory than what the final situation. So given that you expect RBI to again overshoot, one would expect the inflation projection to go up, and this time I would feel with some justification, because as I said, you already have a US economy growing very rapidly and a fiscal stimulus. There's a very strong likelihood that inflation in the US will cross 2% in the month of April. We also have the trade wars, none of which is going to do any good to prices all over the world, and crude, as we've seen, has been in the range of $70 a barrel. Add to that, the government is shortly going to review its MSP, and in an inflation, as I said, pre-election year, the government is likely to slip, if at all, on fiscal deficit, not to be over tight. So for a number of reasons, inflation is likely to edge up. How much the RBI would like to estimate, I don't know. We'll have to wait and see, but I would think that given the fact, as I said, that they've always overestimated rather than underestimated inflation, we will see an increase in the inflation projections, particularly for the second half of this year.
Okay, Maithili, you know what, hang in there. Let's take it across to Poonam, because she's been talking to all economists as well as bankers across the board and noting down what they're feeling about what to expect from the policy today. Poonam, what is your poll throwing up? Because the street seems a little divided, where they're, in tow when it comes to a status quo policy that the RBI is not going to move on rates. But what about their tone? Is it going to be neutral or will it be hawkish?
Well, honestly, the official tone, Aisha, it's most likely to be pretty much neutral, but the overall underlining tone, the commentary, it's likely to be slightly hawkish. To recall, the MPC minutes sounded fairly hawkish than the official tone, which was at neutral during the last policy. But I should just want to point out, look at the bond markets. 7.28 in terms of the yield. The yield was somewhere around 7.30 just last time, just yesterday itself. So the bond markets are seeming or going into the RBI policy in a slightly dovish tone. So I guess the bond market reaction would be fairly important to be watched out for, because I've spoken to a lot of economists and bankers. They do state that the underlying cautious tone is going to be there. Official neutral stance with the status quo. What has also moved between February policy and now April policy is the fact that 33% of economists were expecting a hike in rates in H2, but now the percentage has moved to 56%. So that's the expectation broadly. Besides that, the reason for a status quo is, of course, the fact that the headline inflation has come down and the growth recovery is still at a nascent stage. The recent manufacturing PMI was also at a 5-month low. But the fact is that core CPI inflation still remains fairly sticky. There are inflation concerns, although there is expectation of a normal monsoon. RBI may wait and watch out for how monsoon shapes up. Oil, of course, is the joker in the pack. They would also want to wait out for how the GST collections shape up. GST collections haven't been so far so good. Not just that, RBI may also want to wait and watch out for the MSP hike impact given an election year. RBI's commentary in terms of the liquidity and the H2 government borrowing would be again fairly important from bond market perspective. Will RBI, any commentary in terms of FPI limit hike in terms of the bond market would again be fairly positive for the bond markets. Again, watch out for RBI's commentary in terms of the impact of the trade war, in terms of the growth. There are not many do expect RBI to change the inflation or the growth forecast in this policy. Many do state that RBI may want to wait and watch out for until June for revising the inflation and growth forecast. But as of now, cautious tone is what I understand from most of the respondents. If at all the commentary is even slightly dovish, Aisha, I guess both the bond markets as well as the equity markets would rejoice, but as of now it's slightly unlikely.
Okay, and Poonam spelled it out right there. Okay, on that note, let me also bring on board Sajid Chinoy, Chief India Economist at JP Morgan. Sajid, afternoon. Just about 15 odd minutes left to go before we hear from the MPC, the first time this fiscal. What are your key expectations from the policy?
I think the expectation is quite straightforward, that we expect a hold given current growth inflation dynamics. I think what's a little bit more tricky this time is the tone of the policy. And the reason I say that is there are opposing forces that the RBI must confront. I think all of us acknowledge that inflation risks have gone up compared to a few months ago. Remember back at the October policy review, the RBI had pegged oil prices at 55. Oil remains notoriously sticky, close to $70 a barrel, so that's one risk. I think the big elephant in the room is what happens to food prices later this year. and how successful the government is in ensuring that higher minimum support prices become the floor for food prices. And I think third, there's more conviction now that growth has bottomed. We saw GDP growth in the last quarter surprise to the upside. There's been some softening in the last couple of months, but the fact is, there's more conviction that growth's recovering now than there was 3 or 4 months ago. All these factors should argue or should result in a more cautious RBI. What's different, however, is that, again, just like the start of 2017, food prices have begun to surprise sharply on the downside. So you've seen, February CPI at 4.4. We think March will go down to 4% or even less, and April will stay thereabouts. So what you will see is inflation in the first quarter of this year undershooting the RBI's forecast by a hefty 50 or 60 basis points. I think that's the tension here, that the near-term softening of inflation data has to confront higher inflation risks down the line. So for me, a lot will depend on how far ahead is the RBI willing to look. If they're willing to look a year or 15 months ahead, I think then it's clear that inflation risks have gone up and their commentary might be commensurate to those rising risks.
Okay, fair point. And given, Sajid, that inflation forecast has been completely off the mark in the past, is there not a case for making a hawkish stance today as opposed to a neutral stance by the Reserve Bank?
The only thing I will say is that we last year, sitting in January or February, everybody was surprised by just the extent to which food prices fell, and they never really came back up. And inflation went all the way down to 1.5% in June, and that triggered a rate cut when nobody expected it. What you're seeing is these are very early signs, but again, food prices have continued to surprise on the downside. So I think the only part that the RBI will want to be cognizant of is, if you are being more cautious, which they may well be today, that you have to trade off how much of this food price decline is transient and how much may be durable like last year. I think the second is also going to be their view on growth. Right now, inflation is coming down. Growth has surprised to the upside the last few months. But, 9 months from now, exactly the opposite may be true. So that inflation pressures go up because of these supply side measures, higher minimum support prices, higher or elevated oil prices. But, growth risks, in my view, are skewed a little bit to the downside because we have a lot of deleveraging that's going to happen or has begun in the banking sector, and that's never the right environment. I mean, that's much needed, don't get me wrong. We need that to clean up our balance sheets over the next 2 years. But what that means in the interim is it's unlikely that credit growth is going to be growing gangbusters, unlikely to see new investments in the next 4 to 6 quarters. And so that's what the RBI will have to trade off. That on the one hand, food prices are again surprising to the downside. We know the risks are higher, but equally, growth may not pick up as much as expected. So I think there are multiple forces at play. You're well right that I think they will sound more cautious today compared to February. If for no other reason, oil is still at close to 70, growth prospects are higher, and there is more conviction that the government is serious about raising agricultural support prices. For those reasons alone, I think they will be more cautious. Whether they're outright hawkish and signal tightening today may be a bit premature given these growth inflation dynamics.
Well, we are also joined now by Mr. Pawan Kumar Bajaj, MD and CEO of United Bank of India. Thank you so much, Mr. Bajaj, for joining us. Let me start by asking you, what are you expecting to hear from the MPC and the Reserve Bank of India in this monetary policy statement?
See, basically right now, as you know, whatever poll has come from various economists and other bankers also, status quo will be maintained for this time. As rightly said by my previous speaker also, about the inflation rate. Right now, whatever is there, it is, I think, in the territorial of RBI, but time to come, if first half RBI tells us that inflation would be on the higher band, definitely they will be going very cautious. But as far overall picture what is there in the economy, I think status quo will be maintained with neutral stance with some caution. that is going to happen. And as we know about US also, that inflation is picking up, but whatever their economists, they say yes, rate hike won't be that fast, because that will basically, that kind of growth may not take place, and whatever earlier stance of that further 3 hikes, now we are expecting only 2 hikes there itself. And looking into our GVA growth also, if we want to achieve whatever more than 7% for the means 18 19, definitely means right now I don't see any rate hike immediately is there. Only in the second half or the start of the next calendar year, it is some hike is possible.
Okay, and that must be good news for all of you, particularly public sector banks, because you're already sitting on huge treasury losses. So to the extent that the RBI does not hike rates, you certainly will not have to incur any more losses. But are you hoping that the RBI would give you any further concessions? They've already announced some elongation in the terms of the period for which you can, accommodate your mark-to-market losses. But are you hoping to see some more concessions from the Reserve Bank of India?
I think whatever this latest forbearance they have given, that is, I think, is more than market expectation, and whatever treasury losses for the December and particularly for the March, they have allowed us to do in, never expected that, and that will take care of. And if we are not seeing any hike in the first half, and so in that case, basically, that is good for the market, and particularly banks won't be incurring further losses in that case.
And now we are also joined at this juncture by Obik Barua, Chief Economist of HDFC Bank. Obik, welcome to the show. What are your expectations from the Reserve Bank of India and the MPC? And this time I'm making a distinction between the two, because I'm hoping to see some announcements from the Reserve Bank of India on the banking space, which is normally where they normally keep very quiet. You don't see too many developments being announced on the banking space. So on both monetary policy as well as in the banking arena, what are you hoping to see from the MPC and from the Reserve Bank of India respectively? Obik?
Well, I think my expectations are largely about what the MPC will do, which is to hold rates, but back it up with a relatively hawkish commentary, because if you look at the trajectory of inflation, not only are there a number of extant risks, coming from things like oil prices, which have moved up from the kind of levels that we had anticipated earlier, the possibility of increase in agricultural MSPs. But also, if you look at the composition of core inflation, which is the thing that we should be really bothered about, I mean, that shows signs of being more broad-based. So inflationary pressures in a more sort of general sense have actually picked up. So although I think there is reason to hold, there could be it could be sort of couched in a considerable degree of caution. On the banking space, and coming back to the question that you were raising earlier about what more the RBI can do in terms of helping the banks with their profitability and their bond books, one of the things that is doing the rounds is the fact that the foreign limits, the FPI limits, could be raised. That announcement need not necessarily come in the policy, but that's something which one should expect. There could be, some. I think the RBI will stick on the liquidity front. The RBI will stick to the neutrality position and keep the system roughly where it is, which is sort of hovering around a zero balance, but assure the market that there would be, and perhaps offer a couple of more ways to liquefy the market in terms of need. And there could be some regulatory changes which are so micro that I really can't get a handle on it. I think more fundamentally, Maithili, the issue is that we are in the middle of extremely high global risk coming from all corners. And I would really welcome something from the RBI side on in terms of a discussion on the financial stability of our markets and our ability to withstand any unforeseen or foreseen shocks.
Absolutely. Praveen Kumar from SBI as well joins in. Mr. Gupta, afternoon. Would you concur with Abhik Barua that perhaps the RBI, while it may not move on rates, it could very well have a cautious stance because of sticky core CPI? And what is it that you're expecting from them in terms of a commentary, given the global dynamics and the precarious position that we are in currently?
Yeah, I think the consensus seems to be that there won't be anything on the repo rate, and probably the RBI will continue with the neutral stance. So I think as far as the monetary policy as such is concerned, I think on the interest rates probably nothing much may happen. But I may differ slightly on the inflation trajectory. I think we are already at 4.4%, okay, and RBI had projected 5.1 for the first quarter, and the projection for the going forward was 5.1 to 5.6 actually for the first half. So I think that the inflation may undershoot there. So even though the oil prices did move up, I think some correction has already happened there. So probably they may not overshoot the earlier estimates. I think I'm expecting a little bit of downward revision to the RBI's earlier estimates on that. Yes, I think the current banking scenario in India, the banks do have a lot of pressures, okay, I think on the NPA provisioning as well as on the other provisioning which was coming from the market, the portfolio, bond portfolio that the banks have been holding. But I think RBI has already acted on that. But we would be looking to see, what other measures the RBI can take actually. At this point of time, it's difficult to say, but I think yes, some commentary on what they expect actually how the banking sector to really move forward in the next 1 year would be very welcome.
And do you expect, Mr. Gupta, that the MPC would touch upon the worries of a trade war? They may have ebbed off with Donald Trump's tweet overnight, but the fact that there is that tariff hike which has come about in steel, although just restricted to China as of now.
I don't really think that in the policy, at least, we will see anything on the trade war actually.
Okay, fair point. Sajid Chennai, if I could get you in, one of the worries in the past few months has been how the bond yields have shot up. Do you think the RBI will substantially increase FPI limits on government securities in a bid to soften yields?
So a couple of things. I think if you analyze why bond yields have gone up, the increase in bond yields in the last 6 months, even after the correction in the last couple of weeks, has been a significant outlier. It's gone up much more in India than in most other emerging markets, or in fact every other emerging market. And I think the way to understand this is, a yield curve essentially reflects two phenomena. One is what the market is pricing in terms of future interest rates, and the second is kind of some risk premium or term premium that investors demand to hold that particular asset. And what you find is in India, really it's the risk premium in the last 6 months that have gone up dramatically. And in a way that is reflecting this much more fundamental demand-supply mismatch that, our consolidated fiscal deficit in the last 5 years really hasn't gone down as a percent of GDP. The center has gone down, but the states have gone up. So supply has not come down as much as people expected. And on the demand side, the policymakers have been right in trying to reduce financial repression. So SLR limits have come down and HTM limits have come down. Now that's meant that even though banks are holding the same proportion of bonds because credit growth is weak, the interest rate risk that they are exposed to is much higher. So as financial repression comes down, but supply is not coming down, and there are these binding limits on foreign on FPIs, something has to give, and that something is the fact that market clearing yields have gone up. So I think we need to understand this on a more fundamental basis. Now, my sense is, FPI limits may go up, but not very dramatically. I think there is a sense among policymakers that a lot of these are volatile, especially in this global environment. These could be very volatile flows. They will be pro-cyclical. They will come in, in the good times. They will leave in the bad times and exacerbate volatility. So we're expecting some increases over the next couple of years, but nothing that's too dramatic. I think maybe where there is some scope is for policymakers to look at the special limit that's essentially true for sovereign wealth funds and central banks. And maybe there's a case to be made that you broaden that definition so you get more sticky money in. But outside of that, I'm not expecting a dramatic limit. That said, we need to fundamentally address this demand-supply imbalance. In my view, the first best way of doing that is to ensure that supply comes down, that those consolidated fiscal deficits do come down. This way, we can keep reducing financial repression and not expose ourselves to foreign volatility.
Mr. Gupta, State Bank of India has been raising its interest rates and is not the only bank, and we've also seen yield rates in the market go up quite dramatically. So does it seem as if the RBI's monetary signals don't count for much, because the RBI has not hiked rates at all since August last year, and yet the market has hiked rates? So what does this mean about the effectiveness of monetary policy, Mr. Gupta?
But I think that the bank rates have to do with the liquidity also. So as you know, at a time when the RBI was hiking rates, actually the market was flush with the liquidity for the last 1.5 years. On account of demonetization, there was a lot of money that was sitting with the banks. The credit offtake was very low actually. Okay, so since you are flushed with the liquidity, so there is no question of the banks being able to raise the rates. I think as the market liquidity has got used, so that is where the banks have to look for the deposits, and there would be a case for increasing rates actually. So I think the market, the deposit rates have probably more to do with the liquidity than simply with the policy rates actually. But I think as Sajid said, there's a lot of fundamental shift has happened in the market, and the moving from SLR to LCR. Okay, so which means that there is a very large portion of your book now which will be mark to market, which used to sit in the HTM earlier and was not subject to the interest rate risk actually, is now subject to interest rate risk. And the second major move that has been happening is that from the shifting of the loans to the bonds actually. So a lot of large better rated customers have been raising a lot of money from the market actually. So all of that which is sitting with the banks is now subject to the mark to market risk actually. I think this is where the fundamental change has happened. On top of it, with the low credit offtake, I think the size of the holding by the banks had increased very substantially. On top of it, you had the demonetization money came in, and the movement in the interest rates in the bond market was very, very sharp actually. I think that is what prompted RBI to come up with this one-time dispensation. But going forward also, I think this issue of the banks holding very large bond portfolios which are subject to the interest rate risk is going to be a fundamental different from what the situation was till now actually.
Oh yes, in fact many things have changed over the years, in fact which brought me to my question, where you spoke about rates being affected more by liquidity, which is precisely the question. If ultimately rates are going to be decided by liquidity, and RBI's influence really, every central bank's influence is through the liquidity channel, but if RBI has so little impact on liquidity, then ultimately what matters more? What counts for interest rate determination? Demand and supply of funds in the market, and the central bank with limited ability? That was my question, which is why I'd like to at this point get in Mr. Pawan Kumar Bajaj and ask him, Mr. Bajaj, what do you think? Is the effectiveness of monetary policy, for a variety of reasons, coming down? We have our own problems about poor monetary transmission, but as Mr. Gupta said, ultimately the rates were liquidity driven. So we saw rates collapse dramatically when there was a huge surfeit of liquidity post demonetization, and now we're seeing rates
status quo policy. Maithili, the MPC minutes are out. RBI has kept the repo rates unchanged at 6%. That's the only flash that I have as of now. Quickly bring up, okay, I think we can cut across to Supriya for more details. Supriya?
Yes, so that's right. The monetary policy rates have been kept unchanged, but we were expecting an uneventful monetary policy. I think the big headlines, and I'm going to just take you quickly through the numbers, and if ticker and flashes can take this down as well. Inflation target for the current financial year, fiscal year 19, has actually been reduced. It has been lowered. It is now 4.7 to 5.1% in the first half of this fiscal year and 4.4% in the second half of the fiscal year. Growth targets have been revised upwards. 6.6% was the growth target in fiscal year 18. It's 7.4% in fiscal year 19 and 7.7% in fiscal year 20. So the RBI has also in its commentary and very categorically stated that there are early signs of investment recovery. If I may quickly take it across to the commentary there, MPC minutes have noted what are the 6 broad risks that exist to inflation. Number one, the MSP, and there are no details out as yet. The HRA allowances, Global crude oil prices that have been very volatile and on an uptick in the second half of March. Obviously, fiscal deficit remains a concern. Monsoon, if it turns to be deficient, remains a concern. And fiscal slippage, like I said. So those are the 6 broad pointers. But as far as growth is concerned, and what is giving RBI the confidence to revise growth upwards from 6.6 to 7.4 in fiscal year 19 and 7.7 in fiscal year 20. Also in fiscal year 19, the first half is expected to grow at 7.3 to 7.4%, and the second half expected to grow at 7.3 to 7.6%. What are the factors that will aid this growth? There are early signs of investment recovery. There are also early signs of credit offtake and global demand picking up. Of course, the RBI statement is extremely silent on some of the banking scams that we have seen, the controversies that plague some of the large private sector lenders, and extremely silent on the global potential trade wars. But for now, this is the big headline of RBI. As far as inflation is concerned, it has been lowered downwards because remember the target previously was 5.1 to 4.7%.
Okay. A rather dovish commentary, I should say. Maithili, I mean, are you surprised with the commentary from the RBI, considering all that Supriya read out in details, what they have to say about inflation, about growth numbers? It's a little surprising that they're sounding that dovish.
Oh, well, absolutely. They're sounding not just dovish, sounding very happy and maybe a little complacent, if I may say so, because inflation, yes, at the moment inflation is well under control, but given the kind of uncertainties, particularly what we're seeing on the trade front and what we're seeing with oil, also the fact that as we step into an election year, typically the fiscal deficit targets are always overshot because governments find it very difficult to resist populist demands. I'm a little surprised the Reserve Bank has played quite out of character, if I may say so. So I'd like to see what the voting pattern is. We always had one hawk in the MPC, who we all know is an internal insider to the Reserve Bank of India. But I'd really wonder whether he also has become more dovish. Has the, has the rest of the MPC kind of made him also more dovish? Or is there still a divide? Is it a 3-2 or 3-3? What is the voting? I would like to know.
No, so the voting, and just for the benefit of your viewers, it's a 4-1. In fact, Michael Patra is the only one who's voted for a hike in rates this time around. And just to tell our viewers, everybody else has voted for a pause. Chetan Ghate, Pamidua, Ravindra Dholakia, Veerachar and Urjit Patel voted in favor of the monetary policy decision. Michael Patra was the only lone ranger who wanted policy rates to go up by 25 basis points. So that's really the details as far as this is concerned. But I'll take it across to Abik Barwa, who's also joining us. And Abik, what's your take? RBI lowering inflation targets, and that's big. And perhaps thinking that there's some amount of macroeconomic stability that's returning, and talking about growth forecasts being much higher from 6.6 in fiscal year 18 to 7.4% in fiscal year 19.
No, purely technically, I think the inflation targets needed to be lowered given the fact that we had a sort of a downside surprise on last month's inflation. But having said that, I think the RBI is going a little sort of overboard on its comfort with inflation, and if it's indeed 4.7 to 5.1% over the first half or over the year, we might see some upside shocks there, because given our numbers, we're looking at least 5.5% in June. So I really don't know where the MPC's sort of change of heart or its epiphany has come from. But what has fundamentally changed from the last policy, when they sounded reasonably hawkish, to this time was just one number which came down, one inflation number which produced a surprise on the downside, largely because of food prices. But everything else, both in terms of the composition of core inflation as well as the upside inflation risks, oil, MSPs, you name it, everything, builds for or makes a case for a certain degree of caution against inflation. I'm not too sure whether I have to read the policy and also listen to the press statement. but I don't see there is any sort of very fundamental reason for for the kind of shift in stance that you seem to be describing.
Indeed, Pawan Kumar Bajaj, comment on that. I mean, even I'm a little puzzled that what has really led to the shift in stance, because reasons for an upside risk to inflation have been outlined. What do you believe has led to this change in stance? And do you agree with the robust growth forecast at 7.4% versus 6.6 that fiscal year 18 saw?
See, whatever these policy stance have come, now it is only neutral stance, and inflation means for the first half they have kept it down. So these both two indicators, these are telling, yes, whatever we were earlier thinking, there can be some cautious stance, that is not there. And whatever earlier expectation was that they are going to hike at the end of the year or the beginning of the next calendar year, I think now they have postponed it for more period. That looks like, and whatever projection for the GDP growth to 7.4% for 1920, they are expecting that target is on the higher side. So for that, I feel with if inflation remains on the lower edge, that is possible, and to keep and achieve that level. So this neutral stance, I think, looks like okay, and the only thing we have to see, yes, whatever this growth projection is there, that they are going to meet, but the only means worrying factors are there, that minimum price that they are keeping on the higher side, and this oil means prices, if it goes beyond 70, what it is going to be there. But overall, it's basically what we see is on the slightly dovish side in comparison to last quarter policy.
Mr. Praveen Kumar Gupta, oil has been budgeted at $68 a barrel now. Given the fact that we are seeing, retail fuel prices being at 4-year highs, are you in sync with policy projections of inflation actually easing?
In the inflation projection by the RBI from 5.1 to 5.6, I think our internal in-house view was that the inflation would be a little lower. I think if you look at the 2-3 factors which were being taken into account for the purpose of higher projection, one was the MSP. I think the latest thinking on the MSP seems to be that the impact of it probably would not be as harsh as was earlier anticipated actually. Impact, if any, on account of the higher MSPs because of the revised formula would be much lower. The oil seems to have settled around 67, 68. I think at one point of time it was threatening to go above 70. It did stay above 70 for some time. I think at this level probably it is manageable. The third aspect was the HRA allowances actually, I think, for which there was some concern. I think now that has been implemented, and I think there is a view that the impact of that will now start tapering off. So I think that the estimate of 4.7 to 5.1 seems actually quite reasonable. On the GDP growth, I think if you look at the third quarter, the number was 7.2%. So if they are projecting 7.4 for the next year as a whole, doesn't seem out of sync actually. I think it's a question of being able to maintain that rate over a longer period of time. This particular year, the growth rates were lower because of the exceptionally lower numbers for the quarter 1 and quarter 2, and I don't think that will be repeated, because this year, because of the demonetization and the GST impact, the numbers were actually very bad. So 7.4 does look like a reasonable target for the 18-19. I don't really think that they are really out of sync with what is really happening in the market.
I think the devil is in the detail, and while the RBI is sounding extremely dovish, and that is what we're deriving from it, as are the equity markets, by the way. They're really rejoicing. Though it was Donald Trump's tweet, I would say, negating all fears around a trade war, which were enough for global markets to really rejoice and rebound from what they were suffering all of February as well as March. We're right now sitting at the highest point in the day. It's a 172-point rally that you're seeing on the Nifty futures and a beautiful market breadth, well aligned in favor of the advances. I mean, I can just count the number of decliners on my fingertips. It's only 10 stocks standing to the declines. We haven't seen this kind of a strong breadth in the equity markets in a long time to come. All sectors are holding out in the green. I'm not saying that this is only because of the RBI policy, but definitely this has been an easing factor, the fact that RBI is that dovish. But anyway, coming to the devil being in the detail, and if I look at the assessment notes, the RBI in its first point itself has talked about that since the MPC's last meeting in February 2018, global economic activity has gathered further momentum, both in advanced as well as emerging market economies. They further go on to say that though financial market volatility and potential trade wars pose a threat to the outlook. Point number one. Point number 7, if I just drop down to that. So they're talking about all the internal consumption factors. They've talked about private consumption, domestic air passenger traffic. They've talked about capital goods construction or production rather, which has registered a 19-month high. They're also saying that external demand does remain a weak link. Maithili, should we read more into what meets the eye? And should we really take RBI's dovish stance today with a pinch of salt?
Well, I'm a little puzzled, very frankly, because this is quite contrary to what the RBI's past track record has been. And if I could just be a little wicked over here, could it possibly be that the RBI has come in for so much criticism on the banking front in the past few months that maybe they feel that they cannot take any more criticism on the monetary policy front? And since anyway monetary policy is a very broad brush kind of policy, you could be as right as wrong. So why not kind of play, keep everybody happy and have a slightly dovish tone? That, of course, is on a lighter note. But yes, I'm a little surprised because external demand has been a very important factor. In fact, many economists have argued that one of the reasons why our GVA and GDP did not grow so well is because export demand suffered. And having said that, if the external sector is going to be the weak link, I'm a little surprised that RBI doesn't think it matters as much as most people would think it does, because the hope was that once external demand recovers, the Indian economy growth would also recover. So as I said, frankly, the entire tone of the policy leaves me a little puzzled. It's quite out of character what we've seen both from the MPC as well as the Reserve Bank of India in the past.
Oh, yeah, absolutely. Abhi Barwa, if I could come to you, what's happened today is all well and done. But what next? Do you still stick by that come second half and we will see a rate hike by the RBI, or there is a likelihood that they would continue their neutral stance for some more time to come?
Well, I'm honestly a little confused, and and as you pointed out, I think the devil might lie in the detail. While at first glance or at first impression it might seem dovish, I think there could be a lot of riders thrown in. So perhaps we need to spend a little more time looking at the minutiae of this policy statement to figure out what exactly the RBI is saying. But prima facie, given what you have described, I think the likelihood of a rate hike further down the year has certainly diminished, and perhaps we are in for a long holding period when the RBI does nothing and plays around with liquidity a little in order to either facilitate growth or curb some of the pressures that it might construe developing on the price front. But on rates it might not, if this were to be, if what is being said is indeed the RBI's view that is going to persist, because what we are seeing is not just global volatility, but volatility in the RBI's assessment of things. So if this is this view is going to persist, then certainly the odds of a rate hike further down the year